Hey guys, with crazy acting markets come crazy opportunities for trading options. In this video, we're going to take a look at what is going on and what could be happening next. So here, the history of this chart points to multiple days higher, unless this happens. So let's take a closer look. S&P 500 environment right now, based on our observations, highly resembles February 9th. In order to better understand what happens next, let's first take a look at what was happening in February 9th. So here's a February 9th versus December 27th comparison. Take a look at the formation of this candle right here on February 9th. And just to refresh everyone's memory, maybe you were a part of this day when you were trading, maybe you were not. But in February 9th was the climax of the day when the markets were dropping in February, and literally within that day itself, the markets were down 1,000 points, and they actually finished positive in the last hour of the trading session in February 9th, literally like 100 or 200 points higher. So this was a representation of such action on February 9th, 2018. Now, the important observations are the candle formation. So in other words, the market went significantly lower and bounced significantly higher. We're taking a look actually right now at the weekly chart on S&P, and if you take a look at that, you will see the same type of candle formation. Just disregard the color of the candle for now. Just pay close attention to the formation. So the same similar formation with the tail of the candle sticking much lower and then finishing much higher. Now that's December 27th. Now in December 27th, actually this candle right here would represent December 26th and 27th action. Since we're taking a look at the weekly chart, we're going to take a closer look at the daily chart in a second. Major resistance levels are visited in both instances. So look, in February 9th, we were in a strong bull market at the time. So this drop literally hit the level of the blue line, which was the 50-day moving average. This time, we're hitting a major resistance level of the 200-day moving average line, which represented here in orange or red. So there it is right here. The candle is touching that level. So this is observation number 2. And observation number 3 is the volume. So a lot of times we need to really get some strong volume on the sell side to where we would literally get most of the sellers out of the way. And so the reason why this was the climb is because a lot of volume happened, on between 8th and 9th of February. And once most of the sellers got out, literally we were in a situation to where all of a sudden there were more people on the buy side in relation to the sell side. So we're observing similar circumstances right here on December 26th, 27th. There it is. Look at the volume. Okay, so similarities in the volume. So those 3 major observations. There's a few other smaller ones, but let's just focus on those 3. Otherwise, it would have been like a couple-hour video, and I'm trying to make these as brief as possible. So let's take a closer look at what actually happens next. After February 9th, this was actually a chart from March, but it helps you observe what happens next. Right after that candle formation on February 9th, we're actually getting 1, 2, 3, 4, 5 days higher, followed by a smaller couple of days lower, followed by 3 more days higher. So what we actually got after February 9th is environment for 10 days where the markets are moving higher, 8 days out of 10. 8 days out of 10. So majority of the days higher, literally following 2 weeks after February 9th. Keep that in mind. We're going to do a few more comparisons, but if this is what's taking place now, we're pretty much guaranteed for the markets to go higher unless this one thing we're going to examine shortly is going to take place. Just some further comparison. Just pay attention right here. So now we're looking at the chart of Dow Jones. Okay, so look at the candle formation. Look at the volume observation. Look at the candle formation. Now look at the volume observation. Daily chart. Look at the candle formation right here. Look at the candle formation right here. Look at the volume observation. Finally, on the accumulation distribution, looks like we are indeed getting buyers coming in and buying stocks here, which have not happened in a while since the market's been spiraling lower. Nasdaq, weekly chart, same observation, candle formation, closer to the blue line, volume observation, same type of formation, volume observation. So it doesn't matter where you look at, right? You can take any index and you will see the same similarities. candle formation, volume observation, buyers coming in, boom, right here in the accumulation distribution. So what's causing the bull rally is probably the question that's on your mind. So here's the answer in one chart. Oil is the answer. Oil finally, temporarily finds the bottom. The reason I say temporarily because there's still a possibility that oil could revisit the fresh lows of about 42.5. But right now, what do you see? It's identical, right? Look at the formation of this chart and look at the volume observation here. So clearly, same type. So every major index basically mirrors exactly what's been happening with the oil. And I know if you're paying a lot of attention to the news, they're talking about the Trump, the this, the that. Guys, got nothing to do with the recent market drop. It's all about oil. When oil drops almost 50% within the short amount of time, like 60 days, it's going to get the market going lower. And plus, there's been, clearly some other reasons, but other reasons than the ones that have been given in the media. Now, the reason why this should sustain, because the previous levels of support were also right here from a year ago around the 42 levels, and they held strongly, so this should hold. And take a look at the daily chart. Same thing, right? It actually tries to fall lower a little bit, but it holds that level. And that's the thing. The stock market wants oil market to stabilize. And actually, oil does not necessarily has to go significantly higher. It just needs to stabilize. Like, in other words, if it stop these crazy drops, because even the oil volatility has been up in the 50s. I mean, that has not happened in years. So if oil just stabilizes, then we could see the market also stabilize. And since now we're in a situation where there's more buyers rather than sellers, the stock market actually has a pretty good chance of advancing higher, at least short term. So expect the stock market to do exactly what it did after February 9th, unless oil reverses lower again and makes new lows. Now let's talk about the magnitude of the possible rise. So please don't get carried away in the expectation of like further 600 to 1,000 point daily rallies. Okay, clearly, it's been all over the news, the 1,000 point, the biggest point increase in history and also on. Just don't expect another 1,000 point rally. After the major move like that, the probability of another crazy move higher is just not really good. So calculate a smaller rise. As you can see from the previous chart, right, when we were looking, remember, we're taking a look right here. Look at the magnitude of the further moves higher after February 9th. Look at the size of them. They're not these huge long candles, right? After this big one happens, you have much smaller daily rises. So maybe 100 points, a couple of 100 points to the extent of maybe 300-400 points. But don't expect, crazy moves higher to the extent of, 600,000 points on daily basis. So as the history shows, the magnitude of the moves following such set of events is going to be in the range maybe between 100 to 300 points. Now use this wisely to select your strike prices. You don't want to be carried away buying a ton of calls way out of the money because the magnitude of the moves will be diminished. Now also important thing to observe is after the events of February 9th, even though the trend was clearly higher, I mean, out of 10 days, 8 days were consecutively higher. Every morning, these moves did not start initially in the green. So in other words, you may have situations like the market is actually going to look like it's dropping in the morning and then it could reverse and finish higher for the day. That was one of the characteristics of the environment following these 10 days after the February 9th. And since we're drawing the parallel, I think that's exactly what's going to be taking place. Now let's take a closer look and compare exactly specifically what was taking place in the last couple of days. So December 26th, 27th. We are actually in the second day of what I believe would be a 5-day higher sequence. So bearish reversal versus bullish reversal is observed. So again, see these candles right here, they represent a bullish reversal because clearly after this you see 1, 2, 3 days higher. After the same situation right here, you have 1, 2 days higher. Now, look at this candle right here. This is a bearish reversal. It's exactly the opposite of like this candle formation. So that's bearish, We have another one that's bearish, another one that's bearish. Look at the candles, right? Now we finally get to a reversal point right here. Now in our 13 markets move formula, we have a move 13, which I'm not going to talk about in great detail, but it kind of broke the sequence because of Christmas, because literally, for those of you that have taken the course, it actually got pretty tricky here because of the Christmas and half of the trading day on Monday. If we didn't have that pause and we didn't have the half day, this would have actually translated into a 13 market move 13, which actually by itself tells you that there is a high probability of the market moving higher. So this was actually, here's the bottom line. You've got two bullish reversal candles back to back. Taking the information we've discovered from the February 9th, the contacts and similarities, and applying this to the December 26, 27 sequence, especially combine it with the market moves and the VIX, which we're going to talk in just a sec, this translates a few days higher from here. Now, what do you do with this? What else is pointing to a bullish reversal? Well, oftentimes it's great to observe the volume. So volume actually points to a TRO, a trend reversal opportunity. Just like on February 9th, bullish trend reversal we observed in the volume. So here's intraday chart of S&P 500 yesterday that we observed the divergence in the volume. So typically when you see a multi-top formation like this, top 1, 2, 3, 4, 5 intraday, even though this is an uptrend, it's important to see what the volume is doing. And so in this case, look, as the market was trying to go higher, the volume was going lower. So needless to say, if you've taken our chart course, you would have known that this actually takes you to a drop as portrayed by this line right here. So this divergence in the volume combined with the multi-top formation produces a drop. And it certainly did. So this is what happens after this chart I just showed you. This is what happens. Market dropped from 24.31 all the way to 23.97. Now what happens to the volume? Notice, so we observed the lower volume as the market was trying to go higher. That actually leads to a drop. Now look at the volume throughout the drop. The volume was supposed to increase if there was going to be further drop, but the volume stayed flat. Now 2 o'clock, similar conditions to February 9th, 2018. All of a sudden, the volume starts going higher. Now, this increase in volume is something that has not been a characteristic of the markets for a long time, since October 1st, 2nd, 3rd. So this increase in volume going into the end of the day is actually the bullish reversal that I've been pointing out on the candle. So notice, in the last 2 hours, specifically in the last hour, this volume actually goes to the moon, which coincides with this huge instant almost rise in most of the indices. And here we're taking a look again at the S&P 500. But the similar moves percentage-wise would have been observed in either Nasdaq or Dow Jones or any other index that you're paying attention to. So volume in last hour was crucial, and this signifies a reversal. Finally, we're having a reversal of the characteristic of the market. In other words, generally we've been observing a sell-off going into the close on higher volume. Now we're actually some buying on higher volume. Anytime the buying has been taking place over the last 60 days, it's generally the buying has been on lower volume than the sell volume. So in this case, for the very first time, we're seeing the sell volume is flat in relation to the buy volume. So this is a huge observation right here, especially considering the context of February 9th. And if we take it further with the combination of the VIX, now we really got a pretty bullish picture here. So VIX confirms downtrend for second day in a row. So similar to February 9th and 12th type of events, we've got VIX now closing under 30 for 2 days in a row. So 26, it was in the 29 range, and in the 29 range again yesterday on the 27th. Now, VIX bearish head and shoulders is actually in development. If you take a look at the 5-day chart of the VIX, you've got a situation, of course, where from 24 all the way to 36. Now it's actually creating, on a short time basis, even though VIX is still in an uptrend, it is creating a head and shoulder, which tells me could possibly revisit this 22-24 level before it resumes its way higher. Since market isn't dropping and we got a pretty bullish picture here on the horizon, should you be selling gold? Because All of a sudden, everybody's been talking about gold. Man, the market is dropping, buy gold. Well, if you were buying gold on calculations that you should be buying gold because the market is dropping, that was the wrong reason to be buying gold. Because a lot of times, if you examine the history, there were times where the markets was dropping and gold was dropping like crazy. So when should you be buying gold? And so what are the right reasons to buy gold? Well, contrary to the popular belief, gold does not go higher when market drops. Gold actually goes higher when dollar drops. So if you are understanding this correlation right here, then it clearly makes sense to still be buying gold. Now, the best period for gold, just take you back in the history a little bit, was from 1970 to 1980, where gold went from $40 all the way to $1,000. Now, this is almost like a Bitcoin sort of appreciation, right? I mean, we're talking about crazy percentage return here. So at the same time, notice this. The value of the dollar declined 30%. Let's take a closer look. Historically, gold and oil are positively correlated. So in 1970s to 1980, what happened to the prices of oil? Do you remember? Do you remember the crazy oil crisis in the 1970s? So the rise in gold was taking place from 1970s to 1980s, and the rise in gold followed by a rise in oil prices. Considering an almost 45% oil decline recently, oil could have a crazy rally in the near term, 60 to 90 days. Combine that with a dollar drop, and it really sort of points to similar conditions to the 1970s. That would only strengthen the case for gold, not diminish the case for gold. So lower dollar, stabilization in oil prices are actually positives for the market. So if the dollar was starting to decline, that would actually boost the earnings when the companies here in the States report earnings, especially for those that do a lot of business overseas. So their bottom line would look better. That's obviously a positive for the stock market. Now, it actually increases the probability of advance in the markets rather than further drop. Now, let's take a look at the chart of actual dollar index. I pointed out in the last few videos that dollar was stopping. At the time, dollar was trading maybe right here in the 97, upper 96 handle. As you can see now, it just broke below 96. Pretty strong sell volume here on the dollar. And now it closed at 96 yesterday. But look, the main difference, we were pointing out this stop information saying, okay, the dollar stopping is going to start coming down lower. And so it does. But the key observation here on this chart is now it's not trending above the 50-day moving line. It's actually under. And generally, trading under this 50-day moving line could spell further trouble for the dollar index, and it can easily revisit the next level of 94. Now, don't expect the dollar to fall to 94 in one day. That would be pretty insane move. But we could slowly start the dollar moving lower. And so if this is confirmed over the course of the next few days, we should expect gold to go higher. And so clear, I'm going to show you a chart that's going to show you how strong is the correlation between US dollar and gold actually is. So while the dollar is topping and dropping, gold is setting new highs for the last few months. Now, trades to consider. The practical application of all this that was discussed is this. I would buy Amazon calls, Google calls, Apple calls, gold calls. Amazon short-term price target 1630, Google 1080, Apple 165, gold 1320. Currently, Amazon is trading in the 1400s, about 1450. Google's trading right at the 1000. Apple's trading closer to the 150. Gold currently is at 1281. Guys, if you'd like to learn more about charts, divergences, if you want to learn more about the 13 markets move formula, definitely just click the links below, get more information, learn more so you can make your next year, 2019, your best trading year ever. Thanks for listening, and I'll catch you guys in the next video.